Perdue.
Madam Chair, good to see you again. Thank you for being here and for your service. I just have two quick questions, but the first one, I'm very concerned about global debt. The Institute of International Finance recently reported that their estimate of total global debt is $217 trillion, or more than 300% of global GDP. Is that directionally, do you agree with that directionally?
So I haven't heard that number. That could be, I don't have that number at my
Well,
fingertips.
of that, $60 trillion is estimated to be sovereign debt. We have about 20 trillion of the 60 trillion. With that as background, the four large central banks also have their largest historic balance sheets, as you've said before. Japan, China, EU, and U.S. have collectively they're approaching $20 trillion now of balance sheet size. As you talk about reducing the size of the Fed's balance sheet, are you coordinating with these other central banks and looking at emerging market debt, particularly the $300 billion that's coming due by the end of 2018, relative to the size of your balance sheet here in the United States?
Well, I wouldn't say coordinate. We certainly consult with one another and try to make sure we meet regularly and discuss our policy approaches, make sure that other central banks understand how we're looking at our economies and policy options. So I think the major central banks understand the approach that others are taking, but trying to ask in an aggregate sense how much debt is outstanding is something that we're not doing. Our economies are in rather different situations. While we all encountered weaknesses that were sufficiently severe that Japan, the ECB, the Bank of England, the United States, we all resorted to purchases of longer-term assets to support growth. I would say the United States is further along in the process of normalizing monetary policy, well, at least than the Bank of Japan and the ECB.
Are you concerned about the emerging market debt with so much of that denominated in dollars today?
Well, it is a risk. A significant amount of that is in China, but that's not the only country where there is substantial corporate dollar-denominated debts, and certainly that is a risk that we've considered that affects the global economy.
With regard to the Fed's balance sheet, it's currently about $4.5 trillion. Senator Scott just asked earlier, and I didn't quite get the answer. Is there a directional limit or a target that you have set at this point for the size of that balance sheet? You did say that you didn't see a $1 trillion balance sheet again, but is there a target and a time period that you've discussed publicly about the size of that balance sheet?
So we don't have a target for the ultimate size of our balance sheet. What we've said is that we expect the quantity of reserves in the banking system, which is now a little bit over $2 trillion, to shrink considerably. How small reserve balances will become when we're done this process is something we don't know. A lot has happened over the last decade to affect the demand for reserves. And as this process occurs, we expect to learn more about how the demand by banking organizations for reserves has changed. But I do want to point out that the overall size of our balance sheet depends not only on the quantity of reserves, but on other non-reserve liabilities, importantly including currency. Back in 2007, the stock of currency outstanding was around $700 billion, and it now stands at closer to $1.5 billion. And so even if reserves were to shrink to zero, our balance sheet wouldn't go below $1.5 trillion.
So I'm almost out of time. I have one last question. You talk about this is a long recovery we're in. It's been very weak, but it's been very long, almost 9 years. And the typical recovery in U.S. history is about 58 months, about 5 years. So the question I have is, with consumer confidence right now being at a 13-year high, and yet consumer debt, as you just mentioned, has risen again in the last couple of years back to approaching 100% of household income. What are your concerns relative to the strength of this market, And the monetary or the fiscal policy that's coming out of Washington over the last couple of years and even this year relative to a potential correction in this long-standing recovery, the weak recovery, and does the economy have energy to pop and recover from this extended period of weak economic growth?
So I do have a reasonable level of confidence that the expansion can continue, and we're trying to put in place a monetary policy that will facilitate that. Often previous downturns following expansions have reflected inflation rising to levels that are unacceptable, forcing a tightening in monetary policy, and we have a very different situation now with inflation running below our target rather than above it. Of course, as I said, we are attentive not only to downside but also to upside inflationary risks, and we are focused on that. With respect to consumer debt, I think households are generally in a stronger position. Mortgage debt has declined significantly relative to household income. Student debt has risen enormously. But a lot of the expansion of debt is among higher income households with strong creditworthiness, and the burden of debt payments relative to household income is low. So of course, there are risks in some areas there, but overall, I wouldn't point to household debt as something that is, flashing red on a financial stability concern.
Thank you. Thank you. Thank you, Chair.